Greetings and welcome to the Carroll School webinars. I'm Andy Boynton, Dean of the Carroll School of Management at Boston College. And this month usually marks our annual in-person, on-campus finance conference, which draws together industry leaders, academic researchers, and policymakers for a day of great conversations. And this year, we have continued those conversations, but they're going to be virtual in a three-part series of webinars focused on navigating financial turbulence in challenging times. Each of the webinars features prominent experts and thought leaders and engages the audience on questions ranging from geopolitical challenges, retirement issues, to global financial markets. Today, we're fortunate enough to present the third and the final session in this series, highlighting key trends and opportunities in financial capital markets, even amidst today's deep global uncertainty. Joining us are three industry leaders with diverse knowledge, extensive experience about global investment strategy and wealth management. Our moderator, LoBue, is a financial expert herself, as well as a good friend of mine and the Carroll School. Lindsay spends her days advising the implementation of strategic initiatives at Goldman Sachs. And she does that when she's not running her own startup or serving the BC community as an active and engaged alum. Thank you to everyone for joining us today in this highly informative discussion and captivating wrap-up of this year's Carroll School webinars. If you missed our first two sessions in the series, be sure to check out their recordings on our website at bc.edu/CSOM, CSOM. Enjoy the webinar and have a great day.
Thank you, Andy. I appreciate that introduction. Hi, everybody, and thank you for joining us today. I appreciate you being here for our third webinar, Navigating Market Turbulence, which is pretty timely given what's happened this week. And also thank you for being a part of the virtual BC Finance Conference. Before I introduce the panelists, I just want to mention a few points about today's webinar. I'll spend about 50 minutes or so having a discussion with the panelists, and then after that, we'll spend about 30 minutes or so answering questions from the audience. Feel free to submit questions during the webinar using the Q&A button, and I'll try and get to all the questions during our Q&A session towards the end. Also, my Wi-Fi has been a little spotty recently, so my good friend Ronnie Sadaka, who is a professor and the chairperson of the BC Finance Department, has agreed to step in as moderator if I get kicked off of Zoom or if I freeze sort of an extended amount of time. So thank you, Ronnie, for agreeing to help. With that, I'm excited to introduce our panelists. Our first panelist is Michelle Knight. Michelle is the Chief Executive Officer and Chief Economist at Ropes Wealth Advisors. Our next panelist is Mark Seidner. Mark is a Chief Investment Officer of Non-Traditional Strategies at PIMCO. And then our final panelist is Bob LoBue. Bob is a Managing Director and the Global Head of the Fixed Income Syndicate Desk at JP Morgan. So welcome to all of you, and thank you for being with us today. I'd like to just jump right into our discussion. I think we have a lot to cover. I'd like to just start with sort of the market volatility. So just this week, we've seen days where the market's been down to 7%, the market's been up 5%. You're all experienced professionals, and you've been through different periods of crisis. Is this the most challenging market you've operated in? So Mark, I want to start with you, if you could answer that, and then we'll go through the rest of the panelists. Love to hear from everybody.
Well, thanks, Lindsay. Thanks for having me, and I guess good morning or afternoon to those that are participating. I mean, it's a tough question to answer. I think in many regards, this is probably one of the most challenging market environments I've seen in the 32 or so years I've been an investment professional. And I think, simply put, never have we experienced a government-mandated sudden stop of global economic activity while dealing with social distancing and the effect that has on us both personally and professionally, while dealing with navigating sort of a working environment where individuals and teams that worked so closely together and collaboratively for years are now separated, either working from home or various office sites. So I think when you put all of that together, it certainly becomes one of the more challenging environments from sort of both a personal and a professional perspective. And then the other thing I would say is what we're dealing with is not necessarily what we're trained to deal with. If you give me macroeconomic data from a number of countries around the world, I can tell you whether growth is on an improving or deteriorating trajectory, whether inflation is rising or falling. If you give me balance sheet and income statement data from a number of companies, I can tell you whether or not they can pay their debts or whether they're improving or deteriorating fundamentally. I'm not an epidemiologist. I'm not an infectious disease specialist. And so what we're being asked to deal with as market participants are areas that are not core to our skill sets. And so I think when you put all of that together, yes, it's a long way of saying, yes, this is one of the most challenging environments I can remember as an investment professional.
Great. Michelle, what about you? How has this been? And I'm curious of your thoughts on if it's the most challenging environment you've been in.
Yeah, I was gonna just echo what Mark said. It's really humbling, challenging, humbling, right? Because we spend all of our careers sort of focusing on fundamentals and learning about, the financial markets and the interconnectedness of banks. And when we've faced other crises before, they've had a different, ways we could come at them more analytically. We're all like everyone else in the entire world, hanging off the words of Dr. Fauci and Dr. Birx, and watching our scientists. And so as much as we like to think, as graduates of the Carroll School, that we know everything about the way the world works, this has been really humbling because science is sort of meeting us all, and I think scientists would say they don't. They're trying to figure this out too. And so I would just echo so much of what Mark has said about that sort of intersection between the personal and professional as well, caring for my staff, as well as trying to meet the needs of clients. And this feels different because, and worse and more challenging because it's a health crisis that is impacting my clients. They have family members who are sick, who have passed away. So this is so much more personal than I think I've ever experienced in my career, which makes it especially challenging, I think, for those of us who are navigating.
Yeah. And Bob, what about you? I mean, you've been in the business for over 25 years, working with both investors and issuers. What's your view on this challenging market?
Yeah, I think it's the psychological impact, the speed of the downdraft, the dealing with your families at home. I've been in New York the whole time, so seeing the impact to the city has been hard to then go to work and make decisions based really on hope and belief, as opposed to the fundamental analysis that Mark and Michelle mentioned. And so I think it's been much harder than other crises where you could have a rational thought to an investable end. This has been much more difficult. And I think because of that, clients, and whether that's investors or corporates or sovereigns, have been materially more uncertain of path as well. And the advice has been one of prudence. And I think that's one of the reasons that the acceleration of recovery has been so quick. And then the volatility that we dealt with yesterday comes in on a headline. And I don't think this goes away, which even makes it more challenging.
Yeah, speaking, all of you have mentioned fundamentals. And I just want to sort of understand how you're thinking, and Michelle, I think this is a question specifically for you. How do you think about fundamental investing in an environment like this?
Yeah, I mean, I think one of the things that, as we looked, and we're all sitting in our houses, right? We all have, very limited ventured forays out into the real world to get groceries and to, take care of a few things. And yet from, March 23rd to up until a few days ago, June 8th on Monday, it was like in disbelief watching markets rise. Again, looking forward, as we know markets always do, they always anticipate, excited about the backstop that the Fed and fiscal policy makers were providing, looking forward to the reopening. But as it kept going and the momentum continued to push markets higher, through the beginning of this week, it really felt so very disconnected from the experience that we were all having every day. That's sort of a fundamental, right? There's that piece that it doesn't really feel like we're back. Not to mention the fact that when you're selecting securities, usually you like to go off of earnings and earnings guidance provided by the management of the companies and whatever the municipalities that people are giving you information about where they stand. And they've all pulled all of that away. And so we're really operating in a vacuum, trading off of, hopes and expectations and thoughts about, what the massive amount of policy intervention is going to do. And then this idea that, at some point science will win against the virus and we'll be able to return to normal. And I think a challenge, I think that confronted us very much in the face yesterday was the realization that, maybe that's not going to happen. Yesterday wasn't pretty. I know for a lot of people, nobody wants to be back where we were in March, but it was probably healthy to have, some reckoning there of what the actual conditions are that we're in, and an acknowledgement of the very uncertain short-term outlook.
So you mentioned, fiscal policy a couple of times. Mark, what do you think, how much has fiscal policy affected the volatility that we've seen in the market?
I think we have to say it's affected the volatility quite a bit. It's probably both fiscal and monetary policy. I think we have to be impressed, although my mother always said, don't discuss politics in polite company. And I know that since this is a BC conference, it is polite company. But I do think we have to be impressed with how rapidly both the Federal Reserve and the federal government responded to the looming crisis. And so I think, in many regards, the dividing line between the darkest days, and again, yesterday excluded the darkest days and a little bit sunnier market environment was March 23rd. And so I think we have to applaud the response of policymakers. Yes, it's creating longer term challenges and potential for longer term imbalances and significant potential for longer term risks, but at least in trying to gap the divide between a dark present and a brighter future, fiscal policy has engaged and has done quite a good job. I was thinking this morning, and maybe we'll touch on it later, just the stance of the size and scale and scope of budget deficits and debt burdens. I was trying to think maybe Bob could run out while we're doing the conference to the corner of, I don't even know what the intersection is, but where the debt clock resides in New York City. And man, that thing must be going at light speed these days, right? Because we're going to the U.S. will run a 20% budget deficit in 2020, a 10% budget deficit in 2021, and debt to GDP will likely approach 100% by 2022. And so that debt clock must be operating at warp speed. But again, I think we should all sit back and be thankful that there has been an engagement to help ease the economic pain and suffering for individuals that are hurting so much, and helping bridge and lower market volatility, at least in the near term.
With the volatility right now, and as I mentioned, you're all experienced professionals and you've been through this before, what do you think is the biggest mistake investors make when there is sort of severe dislocation in the market? Bob, why don't I start with you, whether it's investors or issuers? What's your view on that?
Yeah, well, what we tend to see quite frequently, because prices move so materially during crises, are people begin to participate in asset classes that they may not have a core competence in, whether you call it renters or not, chasing return. And there is some risk to that, maybe not necessarily so short term, but the long term of how these asset classes play, and do you understand the risks that are embedded there? And if you think about who many of the buyers are at extreme price levels, it tends to be quite a bit of leveraged money. It tends to be retail shows up looking for return. And I truly don't think they appreciate, and in many cases may not have time to do the fundamental analysis in buying some of the assets that they are purchasing. That tends to me to be the biggest risk as I think about a competent marketplace.
Michelle, what about you? What do you see your investors, what's sort of the biggest mistake they make?
Yeah, so I mean, my business is really working with individuals and families. So, the time horizons are shorter naturally than big institutions, right? And it's the emotional part of this is wealth that they've either inherited or they've created, that they have plans for living, for giving, and it's so emotional to watch your portfolio go through periods of volatility when you have all those plans and all those dreams. And so the whole sort of thesis of the way we think about investing money is about preserve and grow and try to create a plan that delivers consistent, sustainable results through all market environments. But you talk with people about that and they're engaged with that concept when it's normal. When it becomes these abnormal, dislocated environments, you really understand whether people are more upset about the dollar they lost or the one they didn't make, right? There's the psychology of the people you're working with, and it's fascinating as an investor and as a market participant and to help guide people through, not sort of thinking about that as much as that plan, going back to like, well, what's the position here? And I think one thing too, and we really encourage people to think about this, is there's different ways you hold money that you have to really focus on, whether there's personal money, there's retirement money, there's money that you have for specific goals. Maybe be more emotional about this pot of money than that one, and don't feel like you're going to make a judgment on March 23rd that's going to impair your future and returns, because we all know, right, if you miss the first 5 to 10 days of a market recovery, you tend to miss a big portion of that of the ultimate returns that the market deals you. So better to stay invested if possible, and just make adjustments. So it's constantly trying to focus people on adjusting, not wholesale, swinging. So that's great.
And Mark, what about you? I mean, what is sort of your view on the biggest mistakes that investors make?
Yeah, I guess one problem with going last on a panel of this caliber is that all the smart stuff has already been said. So let me just try to add a little bit to what Bob and Michelle have already said. I'd probably build off of Michelle's framework of sort of the emotion. And look, I think we all have biases. And I think what tends to happen in periods of stress or periods of volatility is those biases get exposed. And I think there's a couple challenges that augment volatility in investor behavior. And one is, it's partly emotion, but it is sort of the increasing short-term focus, trying to trade or in fact overanalyze the last data point of information, the last data point of market movement and extrapolating that into a trend, and becoming caught up in that emotion and that psychology. And so I think it's an excessive short-term focus that can be damaging. And if we just, again, if we sort of look back and you did a Rip Van Winkle from February 20th through, basically through today, and didn't read a newspaper or didn't leave your house or didn't look at historical charts of markets, you'd think this is nothing really. It's kind of a normal correction in some markets. You'd say, wow, interest rates have fallen a lot, but there must be something else there. So I think excessive short-term focus is one of the main challenges that an investor faces, and also similar to what Michelle said, what ends investment careers, may or may not be bad investment choices, but it is bad choices about liquidity, about one's liquidity, and either that's in a leveraged portfolio, not having liquidity to meet margin calls, which we saw in so many business models back in investment portfolios back in March. Or if it's personal. If you run out of liquidity, you run out of options. And furthermore, if you try to chase liquidity, if you try to be a buyer when everybody else is a buyer, or in these types of environments, a seller when everybody else is a seller, perhaps that was what happened yesterday, you just push markets too far, and it becomes a critical mistake. So again, I think managing against too much focus on the short term and ensuring that you're managing your liquidity appropriately are probably two areas that investors sort of consistently make mistakes, or put the corollary areas where you can have a fighting chance of success.
It's interesting. You mentioned liquidity and leverage, and it reminds me of the financial crisis. And so, there's a lot of discussions today about how is this similar, how is this different? Bob, I'll give it to you first. Like, how do you think that this environment that we're in now is similar or different to the financial crisis?
Yeah, well, Mark just hit on the word liquidity. And to me, during the financial crisis, we didn't see as big a rush to source liquidity. There was a little bit of paralysis in the market. This time, we've raised over $1 trillion already this year for investment grade corporations. And so when you look at the fact that borrowers very quickly turn to say, my business is disrupted in a material way and uncertain on the recovery, and I'm going to source as much liquidity to bridge that uncertainty. It may not be all I need, but it was a big bite at the apple. And I think we've seen that in other places, whether it's governments, programs that different governmental entities put into place. And that was a big change because we pumped liquidity extraordinarily quickly into the system. And that to me helped stem the tide to take a step back, where during the financial crisis, well, yes, the government was putting liquidity into place where fires were. It took a little bit more time to get that liquidity through the system. So I thought that was fairly material in terms of a differential.
Mark or Michelle, do you have any comments on that, on the financial crisis? Any additional thoughts that you'd like to put in there?
Yeah, just like, one of the things that I think markets should be excited about was just how sure and how fast the Fed acted, and all central bankers really. I mean, they all kind of went to town, and I mean, that really shows like the lessons learned, and in many ways, right? Like the playbook, so many of the same tools all got rolled out again that were so effective ultimately at backstopping the challenges in the financial crisis. So I think as market participants, when you look and see that like swift shock and awe action, that really gave me more confidence to tell my clients, like, all right, look, like, we don't have any corporate earnings reports. We are all in our houses shut down, and who knows when this is going to end. We don't know when there'll be a vaccine, but we do know this. that, these central bankers are doing everything they can to prevent, runs on the bank. That kind of what could have been a very easy fall into a health crisis to a financial crisis. They resoundingly, pounded that possibility out. And that's something. I mean, that is something, it's not changing that a lot of people are dying and sick, but it's something. So I totally agree with you, Bob, about that, and think that's a real positive.
Yeah, the one thing I actually want to move on and talk about sort of the government impact. We've talked a lot about the government being involved, and look, we've seen both the Fed and the Treasury take significant action, as we've all have spoken about on the call here today. I just want to get your thoughts, and actually, Mark, you were called out on the webinar on Monday by Dan Holland, who was the moderator, to specifically answer this question. So I'm going to ask it of you. Given all of the activity, obviously, and you mentioned it earlier, just the size of the budget deficit and the debt burden that we're going to be facing. What's your view on, the risks that we're going to be facing given the debt level that we're approaching or continue to escalate?
Well, first of all, I don't know if Dan's participating, but I consider Dan a good friend, and now I'm wondering if I should question that, given that he called me out on Monday. So I will. I'll have to have words with Dan at a later date. Look, I think it's. I hate to answer a question with sort of it is what it is, but it sort of is what it is, and I guess what I mean by that is. Given the counterfactual of, where we would be if there wasn't fiscal engagement, I think, we all have to, in the context of risk and return, or cost, benefits, and risks, the benefits certainly outweigh the costs and risks, at least at this very moment. So yeah, the statistics are numbing. 100% debt to GDP, massive fiscal deficits for as long as the eye can see. Now, the good news is that while debt to GDP, the stock of debt, is going to be quite high, the debt servicing is actually going to be quite low because interest rates are extraordinarily low. The average Treasury yield right now is about 69 basis points, so less than 1%. So the cost of debt, or the cost of incremental debt, is not as challenging as it has been in the past. And I think the environment that we're probably heading into, and that we should get used to, is one of monetary financed fiscal expansion. Or so this notion of primacy of policy, and I think we do need to get used to that. So I would expect debt levels to remain extraordinarily high. I would expect deficit levels to remain very elevated. Our best guess is that the economy doesn't get back to where it started until 2022, and so basically. An analogy that we've used here, that my colleagues have used, is that the economy took an elevator ride down. I'm in California, so maybe I'll use the Disney analogy of the tower. Took the Tower of Terror down, and is going to decide to climb the stairs on the way back up, and that's going to require a lot of policy. Now, in the long run, somebody's going to have to pay for the debt, which means we probably need to, doesn't mean default, capital D default, but probably little d default. Taxes are likely to go up. Inflation may very well be a result of all of this, and we can talk about that later if that's of interest. So, cost of living may go up, taxes will go up, benefits may go down in the long run. So we'll have to deal with the cost of debt. But again, going back to what I said earlier, I think since we don't know what the counterfactual is, although I think we can assume that we're in a better place today because of expansion of fiscal policy than we would be otherwise, we'll just need to get used to elevated levels of debt, elevated levels of deficits for a period to come, though the cost of it's going to remain very low and interest rates will remain very low for as far as we can see.
Yeah, Powell came out on Wednesday, as everybody knows, and specifically said we're not thinking about raising rates. We're not even thinking about raising rates. So I think if there's not a stronger sign that rates are going to be lower for quite some time, I think that was it. Michelle, I would just love your thoughts, especially as an economist yourself too, like how you think about the risks of the government action. I know Mark went through a bunch of them. Is there anything else? There's obviously benefits, which he spoke about. Do you see any risks that you're most concerned about with the government action?
I mean, I think as we look back on the financial crisis, there was a lot of questions, right, about the moral hazard of what the government did, right, to come in and sort of support institutions that, maybe should have been left to fail. I think by and large, the general point of view would be that there was just no good outcome that would have come from doing that. It would have created a lot even worse impact. I think here there's maybe a little less moral hazard because this is a health crisis. There's no other way, for us to stop or to step in and support. So there's really no question. Of course, implementation is always the tricky part, right? With PPP loans and other things, and we saw some of the names of people taking some of those loans and some of the questions that swirled around that. But no doubt that, again, I think it's necessary. And to Mark's really good points about the debt and the deficit, I mean, it's scary how big it's going to be and how, we don't like to be in that situation. It's the United States of America, right? Strongest economy in the world. Pandemics happen, right? Once every 50 years, long periods of time. I see sometimes, in the financial news media and the press, like all this anxiety around the debt we're taking on and how could we do this and what are we going to do? And we can take 50 years to pay it off too, and I hope, that we never see or experience anything like this again, and we learn our lessons and do better. But, I think that's the type of view we have to have when we think about this. And I think everything that's happening is the right thing to do. And especially as we see our country in so much unrest right now, for a variety of reasons, but, a lot of the sort of economic inequality that is, an underlying problem and that has been for quite some time is really, percolating there too. And I think it makes it even more important for our fiscal policymakers to do the same sort of shock and awe that the Fed is loaded up to do. And so I hope they continue to do it until we see through this.
That's great. Look, I appreciate you bringing up all those points. Debt is obviously an important topic right now. I want to pivot a little bit now to sort of the credit markets when it comes to debt, and to sort of shift away a little bit from the government action, although the government action has clearly had an effect on all markets. Bob, you had mentioned before that you've issued $1 trillion worth of investment grade new issue. And it seems like the new issue market has really been the place or the door that has opened up the credit markets. Can you just describe why the new issue market seems to open credit markets and really sort of what tends to lead this reopening?
Well, this one was driven a little bit more by value than prior crises. But I would say that the real benefit in the liquidity that the credit markets provided companies today there was quite a bit of question in the survivability of many industries. So when you think about the cruise industry, the restaurant industry, airlines, people are having a hard time right now saying, how does that reopen? When does it reopen? Not knowing when a vaccine actually comes into play. And we've not yet talked about the psychological impact of even when a vaccine is allowed to be serviced to people. And so when we think about providing liquidity, and I think about some of the airline deals we've done, some of the cruise deals we've done, we've gotten those companies out to 2022 in many cases. And so we've tried to remove the risk of no revenue coming into those entities while they have needs for liquidity. And Mark mentioned the value of liquidity earlier. And I think that's been important to the equity markets, that there is a confidence to lend to a company with an uncertain operating environment. I think it provided a floor. Now, we had everything else going around with us. Back during the financial crisis, we had the same impact with capitalizing the banks, where we issued billions and billions of preferreds for each bank, and we were accessing the FDIC programs. And you built a renewed confidence in an industry where there was question of survivability, too big to fail. And so I tend to think we're doing the same thing, and we will get to a point where people's confidence, and we'll see on how the reopening goes over the coming weeks and months, where then you will have more insight onto the fundamentals, and you can actually trade equities based on valuations, et cetera. But to me, viability of companies, the credit markets does a very good job on determining viability of an operation, and lending that amount of liquidity to companies across asset classes and parts of the world. I think is quite valuable to that confidence.
When we think about markets that I would say have been slower to open, the securitization market, comes to mind. Mark, I'd love to sort of get your view on, has this crisis affected investors' views on some of the more illiquid markets, and what's sort of going to be the catalyst for those markets to really sort of reopen?
Yeah, I mean, it's a good question. I may just, if you'll allow me, Lindsay, I might just actually build off of some of the things that Bob said, because I think there's a few important points to add before we talk about securitized markets. First of all, it's Bob touched on a few sort of stressed industries like the cruise industry, the airline industry, hotels, lodging away from home, and others, and it goes back to sort of the short-term focus of individuals and investors. I mean, I'm sure all of us have had plenty of conversations with friends or relatives and others where comments have been, along the lines of, people will never go on cruises again. Like, oh, people are never going to get on an airplane again. And I think we need to be careful because, we should never underestimate the propensity of individuals to want to get back to normal as soon as humanly possible. And I think, that's sort of creates the bounds of the opportunity here. So for us as bond investors, as we think about, opportunities in the credit market, we're getting something that we haven't got in a long time. We're getting good, attractive yields in some of these corporate opportunities. And we're also getting security. We're getting collateral. We're getting underlying, in a world where where covenants had almost been outlawed and bondholder protections had been almost entirely eliminated. Now all of a sudden we actually have access to seizing collateral, whether it be airplanes, whether it be cruise ships, whether it be islands, whether it be intellectual property, whether it be hotels, and that's actually a very good thing. And there's sort of a win-win going on. Like, we're winning as bond investors because we're getting attractive spreads and decent collateral. Now, companies are also getting, in many instances, a liquidity lifeline, as Bob mentioned. But for a lot of companies, they're also getting, because of how low yields are generally, extraordinarily low all-in borrowing costs. And so for the first time in a while, I think, Bob is bringing new issues to market where at the end of the day, investors are pretty happy. They're smiling when they get their allocation. And CFOs and CEOs and companies' boards are happy too, because they've got the liquidity lifeline and really low all-in, in either the liquidity lifeline or really low all-in borrowing costs to shore up liquidity. Let me pivot to the securitized markets rather quickly. Because I probably said too much, but happy to dig deeper if you'd like me to. Naturally, there are going to be parts of markets that are slower to reopen than others. I mean, it's almost like blood flowing through the body. There are the extremities of the fingers and the toes where it takes a little bit longer for the blood to flow back. There are some sort of critical issues surrounding the securitized markets that are kind of unique to this crisis, having to do with the forbearance of mortgage interest payments and how that's dealt with, or the possibility of forgiveness of debt. And that sort of creates a fundamental backdrop of a little bit of uncertainty that creates some challenges. But to be sure, as the Federal Reserve has begun other programs like TALF to ensure that credit is available to consumers through credit cards or through auto securitizations, and that money flows back into the mortgage market, not necessarily just through the agency mortgage-backed securities market, but also the non-qualified, non-QM, non-qualified mortgages. Those markets are beginning to reopen. It just took a little bit longer. It's been a little bit slower. There was a lot of focus on the credit markets, and now we're beginning to reopen other parts of markets, and that affects the securitized market in a positive way.
That's great, thank you. I mean, one of the things that one of the sort of investment strategies that was talked a lot about before the current crisis was investing in ESG. And it seems to be a conversation that comes up quite a bit. Michelle, have you had conversations recently with your investors about their focus on that or lack of focus on that, given the new environment?
Yeah, so I think this is, if you thought about maybe the one or two sort of great things that come out of this experience, it's really the opportunity for strategies and investment thinking with environmental, social, and governance factors to have shown their stuff, right? Like, it was true that companies that practice good ESG governance have performed better. Think about, for example, companies that had better healthcare, flexible work arrangements and work practices, right? That had sort of that mentality, so that when this crisis came upon us, they were able to pivot their workforces in a way that others couldn't. Companies that were mindful of, supply chains and sort of where things were and the quality and the health standards within those supply chains. This has been a tremendous moment for ESG investing. It's a small part of the S&P right now, but it also didn't hurt the ESG, typical ESG investor who wants a fossil fuel free portfolio that in the middle of this Russia and Saudi Arabia decide to have an energy price war. That didn't hurt too, but that's, that shouldn't be the headline, because that's a small part of really the markets in this world today. But it's really the idea that good companies that had all of these good practices were able most successfully to cope with the circumstances that came upon us so abruptly. And I think that's terrific for the space. And I think it really makes a strong argument for investors. Like, it shouldn't be a special thing that we're thinking about ESG investing. It should just be risk management. The way we think about those factors is how we manage risk. And so I'm delighted for that. And for the individuals and families that I tend to deal with, but even every day, more increasingly, institutions, this is a priority. And I'm delighted to see the great experience that people were able to, because sometimes there's a stigma that you're giving something up, and this wasn't true in this period.
Great. And Mark, I'm curious, is ESG sort of a topic that's top of mind right now at PIMCO? And sort of how are you guys thinking about that?
Yeah, I think, in fact, we just sort of had one of our quarterly investment forums earlier this week, and it is top of mind. I agree with everything Michelle said. I think there is the possibility that there are many that have to take this moment to focus on surviving, whether that be individuals or individual investment portfolios or asset management firms or companies more likely. And so it is possible that, ESG related initiatives may be delayed in the near term, but then accelerated on the back end. Because I think, and Michelle already mentioned this so incredibly eloquently, but as we deal with the social unrest of the last couple weeks, I think the notion of inequality and justice, which are some of the cornerstones of ESG behaviors and investing, have to come to the forefront of the broad discussion, both in terms of financial markets and society as a whole. And then many of us have probably looked up to the sky and in the past few weeks or past few months and have noticed a dramatic lack of contrails from airplanes, flying behind airplanes. And it's actually now when you look up in the sky and you see or you hear an airplane and you see one of the contrails behind them, you think, wow, that's weird. I wonder where that thing's going. And I think we all have to reflect on the notion that this slowdown or this shutdown, that there has certainly been benefit from an environmental perspective. And I think as we begin to all climb the staircase back to economic recovery, the concepts that underpin ESG investing are almost certainly going to come to the fore of the discussion, come to the front of the discussion. And so while surviving and getting through this period is critical for many, as we put surviving behind us and flourishing becomes part of the equation, how we flourish in a better, more sustainable, more equal way is certainly going to be the cornerstone of the discussion.
Yeah, that's great. And you mentioned sort of flourishing and sort of the future. And I'm curious, right now everybody's talking about the new norm, right? And what does that look like? I mean, I know, Bob, you said that you've been going into your office at JP Morgan in New York. I think, Mark, you're going into the office in Newport. Michelle, I'm not sure if you're going into the office or not, but I would say the majority of people are home. The majority of people are working from home. We expect companies to have probably a split workforce, some in the office, some at home. And so this new norm, I'm curious of what your thoughts are in thinking about sort of flourishing, how this new norm is going to sort of affect your investing strategies, if at all. Bob, I'd love to hear sort of how you think it's going to affect raising capital, or how it is affecting raising capital right now. So why don't I actually start with you? Given sort of the environment that we're in and sort of the expectations going forward, what do you think this new norm is going to do when it comes to raising capital?
To me, I think technology advancement is an important part of it. And so when I think about, I look at the clients on the panel here, some in the office, some at home, the need to connect and identify ways to connect and share information, very important. We're on a Zoom call. When I think about putting clients together, investors and borrowers, we're trying to ensure those connections and conversations are allowable, transparent, fair, and accessible to all. I think that's been a big investment by all of the parties described there. So that's probably been the biggest focus. We will transfer to the focus on the people side in terms of colleagues and how to ensure their safety, comfort. Not everyone's going to be prepared to return to work at the same times. Everyone has different challenges in terms of family life and responsibilities. And so, we were just talking about ESG in the kind of borrower and investable space, but I think the human aspect to what is the world as we come out of this is going to be more pronounced than maybe we're accustomed to on the corporate side, I think, in the future, and at a minimum in the near future.
That's great. Michelle or Mark, do you have any comments about how you think this new norm might affect the way that you invest? Or is it sort of, same as before, just from a different place? Or, is information easier to get, harder to get? Are you pivoting at all? I'd love to get a comment or two on that.
I think on my end, it's we talked about sort of the challenges of investing in these markets, but my business is investing for individuals and families, and so I would personally see them and get to know them, and so all of these Zoom calls and all of the sort of phone call less interconnectedness, it's hard, and I miss that personal interaction, and on the colleague side, I think there's no doubt that it's challenging. There's this push-pull between, are people more productive because there's less time spent sort of shooting the breeze about what's happening in the sports or in different just social interaction, so there's a sense of that. I think from my own perspective, I can't wait to get back to a place where I feel like I can be around safely my colleagues, my friends, my family, my clients. But I completely agree with Bob that it's going to be a period of time, and we're going to have to adjust to that in a way that it's probably going to have some more meaningful long-term impacts than I think we all realize. And I think, Bob, you said this, but we've all focused on sort of the health part, COVID or not COVID, symptoms, temperatures, et cetera. But, we're going to be talking about for years the psychological impacts of this on ourselves, our children, our parents, our friends, our colleagues, clients. There's a lot there. And I think it's, it'll be up to great institutions like BC to try to lead us through, how is this changing all of us? And I look forward to that, maybe being a part of it.
Let me just add a quick word. First of all, and I shouldn't say this in a public forum, but I think PIMCO often gets credit for coining the phrase "the new normal" coming out of the financial crisis. And I'll say this. Hopefully, nobody on the call will repeat it to anyone. But I'm actually getting pretty sick of the phrase, and you just can't turn a corner or open a newspaper or turn on the 6 o'clock news without hearing the phrase, the new norm or new normal. And I think there's a possibility. I'm going to try to convince my colleagues that maybe this should be a theme. Not many of them are taking up on it yet, but I'm pretty persistent. Maybe what we're actually heading into is an old normal, in the sense that the last 10 years were the lowest period of real fundamental economic volatility on record. I'm sure there was possibly a period back in the Ice Age where growth was a function of, well, there was no growth, but you were just watching ice form or recede, and so that was probably pretty slow. But we've got lulled into complacency on this, this period of extraordinarily low fundamental economic volatility. GDP growth in the United States was 2%, plus or minus 0.25%. And perhaps we're going back to some form of old normal, where we all have to manage through periods of radical uncertainty, where the distribution of possible outcomes isn't this beautiful bell-shaped curve where you can assign succinct probabilities to tail events. Maybe we are in a multimodal world or a world of multiple equilibria, and in a world of where policy is dominant, whether it's fiscal policy, whether it's monetary policy. We had repressive interest rate policy for the entire decade of the 50s, where yields were kept extraordinarily low. We may be heading back into a similar environment. So this might be a very old normal. The thing that I worry about, switching a little bit to the work-life balance and the interpersonal, is, I check in with my colleagues all the time, as I'm sure all of you do, and people are doing fine, right? They're sort of thriving in this new environment of working from home and learning how to use WebEx or Zoom or Teams or other means of communicating. The problem that we'll get into in the longer term is grooming the next generation, because that interpersonal interaction of taking the next generation of rising stars in our industry and bringing them along so that they can be the next Bob, Michelle, Marks, Lindsay's. That's where, the longer this goes on for, the longer that will create challenges. And then the last point I'll make is, since we do have Ronnie on the line, or I know that Ronnie's on the line, who chairs the finance department at BC. One of the nice things about all of this is there is going to be reams and reams and reams, similar to what Michelle said, of research that can be done, where hopefully academics can take us to the forefront of learning from this environment and all of it. So those are a few thoughts.
Great, thank you. I appreciate that. We are at the time now where we're going to open it up for questions. So please, if you haven't already submitted questions to the Q&A button, please do that. So we've got some great questions in here. So I'm going to start with one that I think is, well, they're all very interesting, but how are you preparing for the market volatility with the upcoming election? Do you have any scenarios that you predict with Biden versus Trump, or sort of how are you thinking about the election? So Bob, why don't I start with you? Any thoughts would be great. And I think it's a question that's relevant to all the panelists.
Yeah, so specific to the election, I think we're expecting volatility around it. Once again, hard to predict at this point, but a lot of people are talking about the fact that we're in a recession. Pretty rare that the incumbent wins in a recession. Yet we don't know if we will be in a recession in November. And so when you look at the fact that the economy has moved so quickly, yet there is an expectation of material recovery, I think it's very difficult to be one-sided from a prediction. To me, that's causing some acceleration of positioning, some acceleration of activity in markets that may become more muted immediately ahead of it. Now, there's a heck of a lot that's going to occur between now and the election that I think it's fairly difficult to position yourself exclusively on a view of what may happen with Biden or Trump or the Senate or the House. But to us, it's more about taking advantage of the opportunities as we see them, but being prepared and maybe managing your risks as you get into the latter part of the summer and early fall, where clearly the rhetoric is going to spike. And clearly we think the markets are exposed for more volatility around that outcome.
Great, thank you. Mark or Michelle, do you have anything to add to that?
I mean, I would just say, kind of thought that was going to be the biggest problem of 2020 was the election. That was wrong. But it's still a major, as everything Bob said is so true. And I think, realistically, having gone through this recently, is it's hard to put a trade on or position on here in June about something that most people are deciding as they walk into or potentially write in, or who knows, under the current regime, their vote. People are making that decision on the spot. So I think it's a challenging thing, and it's obviously so charged right now because of where we are and what has happened. What I always like to tell my clients and remind them of is that obviously, who the president is and who our global leaders are affects, the economies and the markets that we operate in, without a doubt. And I don't want to downplay that. But at the end of the day, you don't invest in a president. You don't invest in a Fed chairman. You invest in a company, and a company that makes earnings, and you're investing based on what you think the future value of those earnings are going to be. So you got to keep that right in front of you all the time, and not try to manage your portfolio to who you think the president's going to be and what you think they may or may not do, they have influence, but you're investing in companies.
Great. Mark, do you have any additional thoughts on the election?
No, I think Bob and Michelle covered it extraordinarily well, and so don't think it makes sense to add. And I do think Michelle's last comment about focusing on companies and fundamental analysis is critically important. There will be winners and there'll be losers in this environment and in the coming political environment, and ensuring that you're investing in business models, whether it be on the equity side or on the debt side, that are sustainable across a number of different political regimes or a number of different economic environments, is going to be key to success. Because while we've been able, and this is not necessarily related specifically to politics, but while we've been able to bridge the liquidity divide that has come from the sudden stop of the economic, of the global economy and the U.S. economy, the fact of the matter is that the 2020 GDP growth is still going to be somewhere in the order of magnitude of -6.5%. So the economy is going to contract by a reasonable amount in 2020, which means that where there are challenged business models, where there was already fundamental risk, that will be nothing but exacerbated by the current environment, and may even be pushed forward further by the political environment. And so focusing on fundamentals and bottom-up research is critically important.
Great, thank you. And we've actually getting a question on inflation, which you had mentioned before, Mark, which you sort of briefly touched upon. So I'll ask the question. Would love to get your thoughts on that. Is inflation the path of least resistance to address the debt/deficit, or will there be fiscal/monetary tightening before we get to that point?
So the short answer to the fiscal or monetary tightening before we get to that point is no. The Fed has been missing on its inflation target for a decade now, and I think, quite frankly, there are academic phrases for it, but you'll put it most succinctly. I think the Fed will be more than happy to tolerate a little bit of inflation above their 2% target for a period of time, because they know that they have the toolkit to fight inflation. It's deflation or disinflation that is becoming much more challenging to fight. So I think the Fed would be quite permissive with regard to a little bit of inflation. Maybe more so good and service inflation rather than asset price inflation. So you have to differentiate between the two. But I think the Fed will be very tolerant of inflation generally. And just a point on inflation, the inflation protected bond market is currently implying about a 1.2% average headline CPI for the next 10 years. Maybe I'd take the over. I'm not necessarily a betting person, but if I was a betting person, I'd take the over. Just simply, let's say, as Michelle, I think, mentioned, let's say there is a vaccine. Let's say there is a therapeutic. Let's say we do get back to some form of old normal. Let's put that in the context of the fact that the economy was fine going into this. And then let's add in an $8 to $10 trillion Federal Reserve balance sheet. Let's add into that a 10 to 20% federal government deficit. That's a lot of policy. Let's also recognize that there is, likely to be a deglobalization trend that exacerbates or continues out of this. Let's add in the fact that supply chains have been disrupted, if not destroyed. Let's say we are constrained into how many seats can be sold on airplanes or how many seats in restaurants can be filled. Let's say that folks do want to get back to normal, and you create this world of excess demand and just not enough supply. I would not dismiss the possibilities of increasing inflation. Again, maybe not 1970s like inflation, because we do deal with commodity prices, but in terms of goods and services, I would not dismiss an increasing inflation rate over the secular horizon, a 3 to 5 year horizon.
Michelle, do you want anything to add anything to that, or is that given your role as chief economist?
Yeah, I mean, I agree with what you said, and on the one point about the deglobalization, I just want to mention too, like, that, sometimes people focus on that and say, well, that's going to create so much pressure on companies, and then we're all going to have, everything's going to cost more, and it's going to be a disaster. And I think when we go back to the spirit of what globalization was meant to be, the idea that we are opening up markets, we're promoting innovation while optimizing cost and risk. I think we can course correct without thinking that it's going to unleash this other gnarly beast of inflation. We've seen there are, we tend to think about deglobalization in this weird way. It's like there's one other country that we're thinking about, China, right? There's a lot of other countries. There's a lot of other ways for us to be global and maintain all of the good things that we got from that experience without sort of putting ourselves in a position where it's necessarily true that costs will go up, that things will change. So I'm excited that in the hands of good leadership, and I know we have a way to go to get there, that we could maybe think about it that way, instead of the worst case scenario, that we are necessarily going to be in an environment where everything's going to cost more and be very challenged. I'm not sure about that.
Well, you mentioned globalization or deglobalization, which actually is a great, and you mentioned China, which is a great segue into the next question from one of our participants, which is, given the rising tensions of US-China, what are the implications for investments? So, I open it up to any of the panelists that would like to answer that, and sort of whether it's investments or whether it's how companies are thinking about developing their products. So I don't know if Mark or Bob, if you want to take that.
I'll give you a corporate view. I think many companies felt exposed when the pandemic hit and the shutdown occurred. And so I do think that many companies will reevaluate their supply chains. I don't know that it means it all comes back to the US. Clearly, India has been benefiting from some of these discussions, but I think you will see more productivity around the world so that companies are not exposed to one specific supply chain. So that will likely mean CapEx. It will likely mean that corporations are looking for fair trade relationships. So there's a governmental angle that I do think the election will be important to trend over the next 4 years. I would also pay attention to tax regime. Companies are highly sensitive to tax regime, and obviously that's a political topic as well. But when you think about these companies, they're trying to focus on the bottom line. And so the benefit of having more choice and less exposure, there's a cost offset that needs to be balanced with the return to that and the risks associated. But there's no question it is a key focus, and I think you're going to see very fast change to certain sectors. Technology and healthcare are the most obvious, I think, that was clearly exposed during the pandemic because of its reliance on China.
Great, thank you. I don't know if anybody else wants to comment, otherwise I'll move on to the next question. I think I'll just move on. I think one of the interesting conversations, actually, Michelle, you and I had before when we were sort of preparing for the panel, it actually does come from, there's a question that one of our participants has asked very specific to this, which is, what is driving the disconnect between the markets and real life? Many people are experiencing difficulties in their day-to-day, and how is there sort of this disconnect, and sort of conversations that you're having with your investors on that?
Yeah. Again, we know markets are a forward-looking animal. They look, and they're also very impacted by all the levers that are being pulled in fiscal and monetary stimulus. And in your personal life, right? Like, you can sort of see some of that on TV, but you're not, you're dealing with, you're homeschooling your kids, you're waving to your parents or your grandparents through a window, dropping off groceries on the doorstep, and hopefully, and I hope everyone in this call is healthy and safe, but hopefully no one's actually dealing with health impacts from COVID at this point. But it is remarkable to see when you think about the backdrop that we're all operating from, and then to have watched market action from March 23rd to June 8th. And that is true. I talk to my clients all the time. There's there's a difference, when we go back to March 9th, 2009, when the market bottomed after the great financial crisis. There were years where unemployment was terrible. Nobody felt good at that point in time either. There was a lot of, people upside down in houses, foreclosures, a lot of financial stress. And of course, let's go back even further to periods like the Great Depression. But again, when we invest in markets and when we look at what's happening in the markets right now, we have to recognize that they do look forward. They are trying to understand where we're going to be when this is over. So for the next 6 months, 12 months, we're going to be getting terrible economic data. We're going to be, watching people, like you've seen these lines, people getting groceries from food banks. We're going to see that, and then we're going to see what's happening in the stock market, and they're not going to match. I think that's not unique to this period, but it is challenging, and it further exacerbates that sort of disconnect and that feeling of inequality that has now created this additional stress to our environment that we have happening right now, where, in the face of both, police brutality and racism, we also have the underpinnings of just so much, concern, angst, sorrow, can't even put words on it, just around the separation between the two Americas, that is a reality. And I think what we hope is that, again, going back to like great institutions like BC, leaders, and it's not just political leaders, right? It's leaders of all these institutions, these companies, these financial institutions, that they're putting their heads together and working together to figure out, like, how do we make this better? We'll have a tremendous opportunity here, to some of the points that other panelists have made. There is a lot of money sloshing around. How we invest it in infrastructure and could really change the way we think and plan from a urban perspective, from a environmental perspective. There's a lot of good that we could do here if we seize the moment. And so, as much as I can understand people's frustration with that disconnect, I also encourage them to be a part and actually to do what they're doing, to use their voice, to say, I want this to be different, and I want it to be different like this. And I think people are listening, and I hope that's what comes from this pandemic as well, and from the other crises that we're experiencing.
I think that's great. I think that's I think it leaves us with a little hope that people are really focused and can actually create change. I think one of the things that one of the questions that has come through is actually very similar to what the last person had asked, which is in the same vein of, when it comes to issuers having a disconnect between their earnings being having operational difficulties and then them being able to access the market. So there was just one panelist, audience member, who just wanted to expand on that a little bit on how you're having conversations with these issuers when it comes to this disconnect between what they're feeling and then their access to the market.
Well, the most interesting part is, in many of the deals that we've done, issuers have withdrawn their earnings guidance for the year prior to us going to market. And so when you talk about the uncertainty on the left hand, where companies can't predict the next quarter, in some sectors can't predict the next customer to an extreme. Yet the cost of liquidity is so low. Now, maybe we had a month from the most volatile point in March to April where spreads were materially elevated, but we've recouped approximately 70% of the market widening in credit, and rates are lower. And so I think the fact that the cost of liquidity is so advantageous to borrowers. Now, also don't forget, the Fed has put in to the marketplace a secondary market and a primary market facility that issuers can also access. And then you have Main Street lending and other programs. That their access to liquidity is not penalistic, and the uncertainty is so high. To me, that's a very benign option for an issuer to own. The worst case, you've overfunded. And if you've overfunded and the recovery is so strong, you can buy back your shares, you can look for strategic advancement, you can trend in a direction that Michelle has highlighted to what else can you do to advance the economy or your workers, et cetera. There's a lot you can do with those proceeds that you've sourced at very attractive rates. And so I think they're all feeling and understanding what the world is like, but they're trying to do what's best for their employees, their customers. And I think their intent, and I used the word prudence when we first started, their intent is really that they're buying insurance in an unknown environment, and they're happy to warehouse that cost until there is greater certainty, and then they can make the correct decisions on how best to use those proceeds.
Great, thank you for that. I want to move on to another question that we're getting actually regarding the economy. Mark, maybe you can answer this. What shape do you think the economic recovery will be? V shape, L, deep recession? What's your thought on that?
Well, it's certainly not going to be V-shaped. Now, I'll put some numbers on it, right? So we expect second quarter GDP growth to be minus 45%. Again, which is an annualized quarterly number, so it's that obviously overstates it. Third quarter be plus 20%. Fourth quarter be plus 2.5%. So again, you had this dramatic shutdown. You begin to get a managed reopening in the third quarter, recoup about half of your losses, and then it's a much longer multi-quarter event to get back to anything close to where we started. So if you were to put a shape on it, some have referred to it as the Nike swoosh. So maybe it looks a little bit sort of like that Nike swoosh in terms of recovery, that big down, big recovery, and then kind of tapering off. That said, I mean, as investors, we have to worry about not just the base case. And then, like I said, it might be a multimodal world. You have to worry about the tail scenarios, and there is certainly a W-shaped tail scenario, which does bring back some form of the disease as we relax social distancing, as we reopen the economy, as people begin to interact, come back to offices, go out to restaurants, travel again. If there is the very real possibility of an upturn in the disease or infection rates in the fall, which then would create some form of W. I think officials have learned a lot. It's unlikely that you would get the dramatic shutdown that we saw in March, April, May, and heading into June, but there will certainly be a slowdown again in terms of the economy, and you can't rule out the possibility of a W. So base case is some form of Nike swoosh, but can't rule out a meaningful probability of a W.
Great, thank you. I think we have time for two more questions, so I'll just, one of them is actually taking us to Latin America. And the question is, what is your take on future investments in emerging markets, especially Latin America, that is being hard hit because of the failing public health systems, or any opportunities in these markets? So I will sort of open that up to the panelists, whoever would like to sort of jump in and answer that, that'd be great, either from an investing standpoint or from sort of an issuer standpoint.
I'll jump in on what we're seeing, Lindsay. So we've actually had very good success in funding the sovereigns. And so I think that you will see more market access there. We're seeing inflows in some of the emerging market equity asset classes. People do think there is value there as well. But there's no question the economies, and I would say this about the broader emerging markets, the economies are much more challenged than the conversation we just had about the US. And so to me, the pandemic has the potential to cause that to be a very challenging environment as we move forward and get more granularity on its material impact. And I think as you get into the corporates there, can be quite challenged because of the breadth of the sovereign debt that's outstanding.
Thank you for that.
I might just add, it's not just the health crisis that is challenging Latin America. I mean, obviously, Argentina is currently negotiating with bondholders. They are in default, and it's not clear how the current regime, the current government, wants to think about their economy going forward. So Argentina may be uninvestable. Brazil, which is sort of the epicenter of the healthcare crisis today, also faces its own set of political challenges as we head forward. So, some of the larger, more headline countries or opportunities certainly have challenges beyond the healthcare. There are other countries like Peru and Colombia and Chile that actually have, and this is from a debt holder's perspective, that have good fundamentals and are investable. If we were thinking about emerging market opportunities from a fixed income perspective, you sort of have four levers to pull. You can invest in hard currency, dollar denominated bonds. You can invest in local currency. You can invest in the currency itself just through forwards, or you can invest in corporate opportunities. The area that screens the most attractive to us would be the today, which wasn't the case a year or so ago, is the hard currency dollar denominated bonds that actually behave more like a corporate surrogate than anything else, and so that's an area that we think is investable. But again, Latin America particularly has challenges in certain countries that go beyond the healthcare crisis.
Well, thank you for that. I have one more question to ask, and then we'll turn it over to Dean Boynton. And so the question that somebody had said is, what do you see as the biggest risk over the balance of the year? So maybe each of you can give just a short minute or minute and a half discussion on what you see as the biggest risk.
I'm happy to start. So, it's the virus, right? Like it's this is an unanalyzable risk, right? So as I think Mark and Bob both alluded to, we know a lot, we seem to know a lot more about it. And we're sort of grappling with every day new findings, and I'm sure we're all sort of personally frustrated, right? In the journey we've been on, where it was like, don't wear a mask, then wear a mask, and don't touch things. But it's okay if you do, but wash your hands, like all of this evolution of what we're learning about the way this virus spreads and how we, can monitor symptoms and understand who might be exposed. I mean, this is the risk for right now. And it means everything to how robust the reopening will be, to that swoosh or the W is what the path of this virus is going to be. And it's really challenging because I think, Mark, going back to the top of the call, you said, look, we're not epidemiologists. We're all Carroll School of Management graduates, like we'll have to go back to VC and get some more training. But, that's the biggest risk. And, but I also believe it won't be a risk forever. And so I firmly believe that. And it is true that we are so, lucky here, at least here in Boston, to be kind of in an epicenter of where people are focusing on trying to find that vaccine, trying to find the cure. So, let's keep wishing for them to accomplish that and bring us some resolution to that risk. But for me, that's the biggest risk, and it's one that I certainly am not able to decipher. But yet I'm still going to help our clients manage through it as best as possible.
Great. Mark, what about you? What's your thought?
It's a really difficult question, because again, in sort of the context of radical uncertainty, the biggest risk is probably something we haven't even thought about, which is akin to what we've experienced this year. And none of us knew what COVID-19 was 5 months ago, or none of us. When you were going through your plans for 2020 at the end of 2019, this was not even a possibility. And I think so. It's in the Donald Rumsfeld framework, it's not the known knowns or the known unknowns, it's the unknown unknowns, perhaps even a little bit more existential, the unknowable unknowns that frame the biggest risk. And I think, again, that's why, I think as investors, it's critically important for all of us to think about risks, not get overly complacent about, policy or shape of recovery or improvement. Ensure that we got appropriate liquidity so that we can manage through a number of different scenarios, and then actually, not stress test for, the COVID-19 episode or long-term capital management or the Russia default or the global financial crisis. Stress test for be creative in terms of possibilities, because while none of us would have thought there ever would have been in our careers a mandated shutdown of the government, well, it happened. Not a mandated government shutdown of the economy. You never would have thought about it. Well, it happened. And so I think the biggest risk is probably complacency in some form of recovery and not being cognizant enough of those unknowable unknowns.
Great. Thank you. That was actually really well said. Bob, you want to just end it up?
No, I'll go on the heels of Mark's point. I would pay attention to how hard the two parties fight for the presidency and the Senate and what's said. And that may be the unknown. They're going to fight like heck for those seats. And the fear is you have some unpredictable people in some of those chairs, that what they do or what they say could have a pretty profound impact on the globe. And I think the markets will react to some of those headlines. So I agree with Michelle. The second wave is the obvious to pay attention to and how governments around the world respond to it. But the unknown, I think, around the election is something to pay attention to.
Well, I can't thank you all enough for being here today and for giving all of your insights and thoughts. It's definitely an unprecedented time on so many different levels. So thank you. I'm now going to turn it over to Dean Boynton to give us a couple of last closing remarks. Thank you.
Thank you, Lindsay, and thank you to all the panelists. That was just terrific. For those that want to view this webinar again or share the webinar with others, you can see the recordings on our website, bc.edu/CSOM, CSOM. Thank you all for joining us today. We hope you enjoyed this webinar. And for some of you, thank you for enjoying all 3 webinars this week. We hope you enjoyed the series. Have a great summer, be well, and be safe. We'll see you next year.